Good morning, everybody. Welcome to today's 1 million by 1 million online rendezvous. And we are broadcasting on LinkedIn Live, Facebook Live, as well as Twitter Live. So good to see everybody. And we've been off for a little while, resuming. Happy New Year. This is the first broadcast for the year. What we've been doing at these sessions is discussing issues that are coming up through all our different touch points. As you know, 1 million by 1 million is the first and only global virtual accelerator in the world. Our mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue. And in support of that mission, we do a lot of work in the media. We do a lot of interactive sessions, whether it's coaching and mentoring of entrepreneurs through online roundtables, in-person rendezvous in Menlo Park, in the heart of Silicon Valley, as well as these sessions where typically we encourage you to ask questions and we collect these questions, and in subsequent sessions we answer those questions. So, as usual, what we've done is collated a set of questions from prior sessions, and I am going to start answering some of them. So, Maureen, can we have the first question, please? The first question is, why are you so bullish on SaaS stocks? So, let me actually set some context about this question so you can, level set on why I'm getting this question. You may know there is a cloud stock analysis that I write on LinkedIn, and it's also syndicated on Seeking Alpha, and it's obviously on our blog. So if you're a cloud stock aficionado, or if you're trying to learn about cloud stocks, it is something that you would find helpful and informative. So I'll tell you, I've been covering cloud stocks for a long time, probably about 12, 13 years, which is almost the entire history of cloud stocks that started gaining ground. It's right around 2007-8 timeframe when the cloud companies started first going public and starting to get real traction. And of course, since then, the industry has boomed completely. So the current market is full of really interesting SaaS companies that have built up to at least 100 million in annual revenue run rate, ARR. Many have gone public. Some are waiting in the wings. There are also many more that are in the 50 million to 100 million range. They serve different segments. Some serve verticals, some horizontal enterprise functions, some large niches, some enterprises, some mid-market, some SME. It's a very, very wide spectrum. And together, the SaaS market is a healthy, robust, exciting cauldron of innovation. Unlike social media, search, or e-commerce, SaaS is not an oligopoly. And these SaaS companies that have achieved critical mass in their own segments now have an unprecedented opportunity of scaling to become much larger businesses by broadening their footprints. They can look within and look outside to identify the growth levers. Let me explain. What do I mean by look within? Any company that has built a substantial business in any software category has core competency within its folds. It has highly capable engineers who have developed some degree of domain knowledge in their sphere. It has product managers who are in touch with customers. It has sales engineers who are in regular and even closer touch with customers. It has salespeople who know the customers and the competition well. These companies need to establish a methodology for intrapreneurship that systematically captures the tribal knowledge that is floating in the organization. These SaaS companies need to proactively identify the 50 million, 100 million, 200 million blocks of opportunities that are adjacent to the current product line and are lying latent. What do I mean by look outside? SaaS has been the most prolific area of entrepreneurship in recent times. There are numerous SaaS companies out there. Do these companies have a systematic process to harness this massive body of innovation that could very well be strategically aligned with their product strategy? Which of these should a company acquire? Which of these should they invest in? Which of these should they do OEM deals with? These are the outside opportunities that need to be strategically thought through. Now, you could ask, why now? You may be thinking that this has been true forever in the history of software. What's the big deal now? Well, the big deal is that since 2013, every year, just in the US, 50,000 to 70,000 startups have received seed funding. SaaS has been a major category in that pool. Currently, this number has likely increased to 100,000 just because the amount of money in the seed market is much larger. Over 500 micro VCs have come into the market in the last 3 to 5 years. These micro VCs range in 15 million to 100 million fund sizes. However, the Series A gap continues to broaden. Only 1,200 to 1,500 companies get VC funding per year. And the metrics required for a company to qualify for a Series A is a minimum $1 million annual revenue run rate, often $2 million ARR. Not only that, Series A VCs want the velocity question answered before they take a leap. Is this company going to go from $1 million to $3 million to $10 million to $25 million to $50 million to $75 million to $100 million in a 7-year time frame? Most companies with or without seed funding don't get to these metrics. This may sound counterintuitive, but those who do are not necessarily your best acquisition targets. They may be good targets for investment alongside a Series A VC syndicate, or perhaps an OEM partnership opportunity whereby you white label their product to sell through your channel to get better ROI on your sales force. But in the other pool of tens of thousands of bootstrapped or seed-funded companies that have not cracked the velocity equation, there are rough diamonds for these SaaS companies to mine. Does the company have product market fit? If so, if you're a larger company, all you need to do is take a long, hard look at why it hasn't achieved velocity. Could it be that they don't have sales DNA? Many tech entrepreneurs start from the engineering side and don't know how to build a repeatable sales process. Is that why they're not scaling? And if yes, then what can your high-performing sales force do with the product? Maybe your sales force is the answer to their velocity question. This is an excellent and very affordable acquisition opportunity for your company. You can probably acquire the company for $5 million to $15 million, depending on how far along it is. And of course, if the company is very, very early, but with a talented product team with significant insights, but struggling to finance itself, then acqui-hire is eminently possible as well. Note also that the opportunity is now global, not just the US, and certainly not just Silicon Valley. India is full of SaaS companies, even Europe has them in plenty. And in these emerging venture markets, exits tend to be low, tend to be fewer and far between. Entrepreneurs and investors are really hungry for exits, and their expectations are often not Silicon Valley scale. India especially has billions of dollars of capital that has been deployed into startups, and very little has come out by way of exits. Now, to tap into this global opportunity fueled by a hyperactive SaaS startup trend, you need to craft precise process and methodology. If you're on the side of the larger SaaS company, it is what I'm talking about. For the last 5 years, we at 1M by 1M have been involved in creating processes of this nature in collaboration with our software vendor partners. The experience has been enlightening, to say the least. Our most successful enterprise software intrapreneurship challenge partner runs 1M by 1M challenges twice a year, open to their 130,000 global employee base. We train large number of engineers with no background in entrepreneurship to validate ideas and assess business cases, size markets, analyze ROI. We are unearthing multiple, several hundred million product ideas a year, and even billion-dollar ideas surface from time to time, all fully fleshed out based on which investment or acquisition decisions can easily be made. On the other side, in our community of 500,000 around the world, we constantly see companies that are finding product market fit and could be excellent acquisition targets for high-performing SaaS companies looking to grow. A recent example is from our January 4th mentoring roundtable, where a small company from India called Voltage came to seek guidance. This company is applying AI to contract evaluation and would be an excellent acquisition for an Aptus, for example. What's missing? I see a lot of ad hoc efforts. I see a lot of catch-all corporate venture fund announcements. I see a lot of Brownian motion. Brownian motion is motion that doesn't generate energy. My observation with my hands deep and dirty in this game is that it is far, far more complex to do this effectively and systematically. But if you succeed, you have a gold mine out there. You can become the next Salesforce, the next ServiceNow, the next Workday. It is doable, eminently doable. So if you are thinking about this problem of growth and product portfolio expansion from the point of view of a larger SaaS company that has some critical mass, keep in mind what I just said. Okay, I'm going to move to the next question. The question is, what SaaS products built on Salesforce.com's PaaS, platform as a service, have gained substantial traction? So the reason this question is important is because Salesforce happens to be the best PaaS implementation ever, platform as a service implementation. They started early, I think all the way back in the mid-2000s, they were already starting to do PaaS. And of course, today they have tremendous momentum on PaaS. So this is a question that is worth discussing. Salesforce.com, besides developing its SaaS products, is operating a very healthy PaaS offering. They opened their platform to third-party developers back in 2005. Since then, it has been significant growth. It has seen significant growth of its PaaS offering. Today, apps created in the Salesforce platform are created for mobile and social use. Developers have access to a number of open source languages, including Ruby, Java, JavaScript, C++, Python, and Node.js. It has simplified the development by providing automatic and custom microservices that help developers manage their processes better, and template apps that can be customized in App Exchange to get the customer's app deployed faster. The service is run on Force.com and Heroku. Salesforce's PaaS has helped provide the backbone for several startups. For instance, Aptus, a leading configure, price, quote, and contract management vendor, has delivered its enterprise class application natively on the Salesforce platform. Aptus started as a bootstrapped venture in 2006 and is a leading CPQ player today with revenues north of 150 million. And they've raised a tremendous amount of funding, more than $400 million. So they were acquired, I think about 2 years back, to Thoma Bravo, which is a private equity player, for an undisclosed amount. Analysts expect the deal value to be around $1 billion to $2 billion. Aptus's biggest competitor, Steelbrick, was also built on Force.com. In 2015, Salesforce acquired Steelbrick for an estimated $360 million. Prior to the acquisition, they raised $78 million. And that actually has helped Salesforce develop its own CPQ, configure price quote offering to compete with Aptus. Other players that have benefited from Force.com include Financial Force and ServiceMax. Financial Force has developed its accounting, ordering, and billing, professional services automation, and service resource planning on the Force.com platform. Founded in 2009, Financial Force has raised $220 million in funding from investors including TCV, Unit Force, and Salesforce Ventures. It is expected to be operating at revenues of $95 to $100 million annually and was last valued during a fundraise at over $500 million in 2015. And ServiceMax was founded in 2007, also built on Force.com, to improve customer experience by ensuring that each service's customer's contextual intelligence can be seen in real time by everyone involved in serving customers. The company raised $204 million in funding and was acquired by GE in 2016 for $915 million. In December of 2018, GE sold the company to Silver Lake, another private equity transaction, again for an undisclosed sum. And then the last example, which is a much bigger company, much more successful company, Viva, was also built on Salesforce.com's platform as a service. So those are some good examples. Salesforce itself has been a tremendously successful company because of all this. Remember one thing, all these PaaS companies have to pay a platform fee to Salesforce. So the success of these companies also adds into the success of Salesforce. And anybody else who's doing PaaS has the same formula, effectively, of monetization. You're not only monetizing from your own revenues, own sales efforts, you're also monetizing from the sales efforts of these companies that are building on your platform. So it's a very, very interesting, range of activities that are happening. Okay, we'll do another question. Next question is, what is an example of a SaaS company that is acquiring from its PaaS marketplace? Well, we just heard about SteelBrick, which was acquired by Salesforce. But I will talk to you about Atlassian, which is a very interesting SaaS company that is also doing a good PaaS community. Atlassian remains focused on acquisition that pair well with its most popular products and could help expand its reach beyond IT departments in an organization. It acquired a company called Good Software. It's a Sydney-based company. Atlassian itself is an Australian company that has since moved its headquarters to the US, but it remains its Australian roots remain very, very strong still. Good Software was founded in 2016 as a side hustle to provide Atlassian marketplace apps for Atlassian's collaboration platform Confluence. Within a year, it had won the Atlassian Marketplace Best New Vendor Award. It now has more than 500 customers for its Atlassian Marketplace apps and provide analytics tools for Confluence users and admins. So the company Good Software was generating about maybe $1.5 million in revenue, annual revenue, the point at which the acquisition happened. And Good Software was a bootstrap company. So it was very much in line with Atlassian's philosophy. But Atlassian, by the way, was also a bootstrap company. It went very far in a bootstrap mode before it raised any money and then eventually went public. It's a very successful IPO as well. Last March, Atlassian announced the $166 million acquisition of enterprise agile planning software AgileCraft. So, that's a much larger acquisition. But I think in general, if you just keep track of what Atlassian is doing, and by the way, we cover Atlassian extensively quarter after quarter, you will see the theme of Atlassian acquiring from their past marketplace constantly. Okay, we'll do another question. And this question is, why is bootstrapping to exit important in the context of SaaS and Paas? By the way, folks, while I'm answering these questions, feel free to ask your questions in the public chat, and I will try to get to them. If not today, in the next session. We have another session coming up next Tuesday, and I will try to address it there. So, bootstrapping to exit is a very, very important issue that you should keep track of. Over the last decade and more, I've had the privilege of working with a number of bootstrapped entrepreneurs. These include self-finance companies, also modestly capitalized startups that operate in a capital-efficient manner, applying the principles of bootstrapping. For our seed capital series of podcasts and blog interviews, I've interviewed hundreds of investors, especially micro VCs and angels who are playing in the early stage game. I've asked all of them the following question. The commercial internet has now been around for 25 years. Lots of stuff have already been built. Nowadays, there aren't so many wide open opportunities out there, but there are many, many niche opportunities. Some of these businesses need to be built for very small amounts of capital. Invest 1 to 2 million and sell for 10 to 15 million. Do you have appetite for this type of investment? What about a notch smaller? Invest 250K to 500K and sell for 5 million to 10 million. What about a notch larger? Invest 5 to 10 million and sell for 50 to 60 million. All these interviews are available on our blog. Go to 1mby1m.com and find the blog, and you'll find the seed capital section where all these interviews are available, and they're also available on our podcast channel. As I expected, a large number of investors are still chasing unicorns. They're interested in investing in companies that will go from 0 to 100 million in 5 to 7 years. And they will consume a great deal of capital in the quest for hitting the coveted $1 billion valuation mark. However, I'm pleased to report that I've spoken with a number of investors who recognize the niche opportunities and answer yes to my questions. Yes, they are interested in investing small amounts and harvesting through smaller exits. In that strategy is the recognition that most acquisitions happen in the sub $50 million price point. Therefore, for all stakeholders to make money, a capital efficient strategy is required. I've also spoken with a number of CEOs and board members of public and pre-IPO companies on what they want to acquire. While the larger companies need to acquire significant chunks of revenue, in the smaller companies, $100 to $300 million annual revenue, often there is a different issue. A $100 million SaaS company quite likely is making most of its revenue from one product. To thrive as a public entity, it faces tremendous pressure to broaden its product line and find 1 or 2 additional 100 million to 200 million businesses. How would they do that? The market, of course, is full of heavily venture-funded SaaS startups with very high valuation expectations. Most of these are not affordable for a small, recently public or pre-IPO company. Instead, a small, capital-efficient startup that has shown product market fit in a domain with strategic alignment is far more interesting as an acquisition target. All right, so that's my guidance on bootstrapping through exits. There are 2 questions worth discussing further. For capital-efficient startups, are you considering the bootstrapping to exit path, or are you obsessing over becoming a unicorn? This is a question that you should ask yourselves. I'm happy to discuss questions on this topic. And for small public or pre-IPO companies in the 100 to 200 million revenue range, the question that you need to ponder is, are you able to find small capital-efficient startups to acquire? And if not, come talk to us, because our community is full of these kinds of companies. Okay, The next question, which is kind of a follow-on question to this one, is can you discuss some bootstrapping to exit case studies? I will do that. So one of our portfolio companies went on to become a very successful global SaaS company, which is, it started life as Freshdesk and became Freshworks eventually. They have acquired a lot of capital efficient startups. I wrote a piece on them recently, which was titled Freshdesk has acquired 9 capital efficient startups. All the 9 acquisitions by Freshdesk or Freshworks have been for undisclosed amounts. Cloud-based video collaboration platform OneClick, acquired in 2015, was founded in 2012 and had raised an undisclosed seed round from Bloom Ventures and the Chennai Angels into 2014. Online social discovery platform Flip, acquired in 2015, was founded in 2012 and had raised $500K in funding from angel investors, including Freshdesk CEO Girish Mathrubootham in 2014 August. And it had an undisclosed venture round with Microsoft's accelerator. It had over 100K users when it was acquired. App customer support offering Conotor, acquired in 2015, was founded in 2013 and had raised $155,000 in seed capital from Accel, Qualcomm, and Target Accelerator. Its platform supported more than 40 million users and has customers such as Zomato, Bank Bazaar, etc. Online collaboration platform FrameBench, acquired in 2016, was founded in 2012 and had raised seed capital from Bloom Ventures and some angels. So you get the idea. This is a company that has, been using acquiring small companies through the platform. Atlassian, of course, we talked about Atlassian. Atlassian has acquired a lot. I talked about a few. It also acquired a company called Opsgenie, acquired Trello. So there's a bunch of different companies that Atlassian has acquired in the same mode. So that's just a good representative sample for you to think about. The next question is, can you discuss the buy side of bootstrapping through exits? Bootstrapping to exit. So there are several factors that play into a relatively larger company acquiring a smaller player. Number one is financials. Companies acquire for different reasons. Some acquire to bring in substantial chunks of high growth revenue. Some acquire to bring in adjacent products that their sales force and channel can upsell to existing customers. Some acquire to diversify out of a one-trick pony situation. I talked about it earlier today. Sellers need to consider the buyer's psychology and accordingly steer the conversation. Valuations vary significantly depending on motivation. Revenue-driven acquisitions tend to be easier to put a price on. Valuations tend to be multiples of revenues, regardless of how much money the company has raised. Strategic acquisitions tend to be more complex to value. They resemble the thought process of a VC. If I acquire your company, how much additional TAM does that open up for me? Can I leverage my sales force and channel and push your products through them? How much additional engineering is needed before we go to revenue? Have you raised too much money, making the valuation expectations irrational? So that's the financial point of view. The next one is technology. Today, products are built on technology stacks that are often incompatible. This makes merger integrations challenging. Take, for example, a SaaS company acquiring another that is on a different technology stack. What is the cost of rationalizing the two stacks post-acquisition? Is there enough ROI post-rationalization to go ahead with the transaction? This also points to the fact that if you build on a compatible stack with an eye towards a business bootstrapping to exit situation, your chances of finding a successful exit would be higher. Hence, all these platform as a service strategies Salesforce's strategy, Atlassian's strategy, it's working well because these numerous startups are built on their stacks and it's easy for them to acquire. So as you design your startup's technology strategy, please keep in mind that technology choices you make will determine whether or not you can find a satisfactory bootstrapping to exit outcome. And then the last point you have to keep in mind is culture. Culture matters tremendously. Whether an acquisition can be integrated successfully or not is often the factor of compatible cultures. If you're working with a B2E bootstrapping to exit objective, study the culture of the potential acquirers and make sure you don't get tripped with vastly incompatible dynamics. There are other factors, but these three are the top ones. I'm going to do one last question. What are your favorite cloud stocks? So yes, I'm extremely bullish on cloud stocks. So I'm going to give you 20 stocks for 2020. And the criteria for making this list are a strong strategy for performance in platform as a service, AI, artificial intelligence, and a robust developer ecosystem. I think these are three criteria that are good drivers for companies that are going to do really well going forward. So let's talk about large players with revenues over $10 billion. The number one, the top company that leads on these fronts is Salesforce.com, and I'm very bullish. I continue to be very bullish on Salesforce.com. It's done very, very well, and I think it will continue to do very well. The surprise in this category, this large category, is Microsoft. They've executed tremendously well on a PaaS strategy, and it has released a new AI-enabled edge appliance called DataBox Edge. I mean, their AI strategy is interesting, the PaaS strategy is interesting, developer ecosystem is interesting. And again, the stock has done tremendously well, and I think it will continue to do very well. And now, Amazon is not a pure play cloud company. Obviously, it is a cloud company, and it is also an e-commerce company, and so on and so forth. So you can't really think of it as a pure play SaaS, but it is a very interesting company, and I continue to be bullish on Amazon because it's also executing extremely well on the e-commerce side. Let's talk about mid-sized players with revenue over $1 billion. Atlassian is very high on my list. I really love Atlassian. I think the company has executed tremendously well, and their PaaS strategy is coming along well. The second one is ServiceNow. Excellent platform. They're doing a good PaaS strategy and have built a lot of AI capabilities as well. They're trying to build a developer ecosystem, although geared more towards larger enterprise system integrators, not so much on the startup side, but that's fine. That's also an interesting, credible strategy. The company has done very well. I have invested, by the way, in all of these companies, and I've done pretty well with those investments. Twilio is an interesting communications PaaS company that you may want to look at. It's a riskier investment and a riskier stock, but it's an interesting company for sure. And then Splunk is very interesting. Very good PaaS strategy, developer ecosystem, has presence in a lot of different aspects of big data. So that's something that you may want to take a look at. And then Viva, I talked about Viva earlier. It's a company that I'm extremely bullish on, very, very well executed. It's a vertical cloud in pharma. It hasn't done a PaaS strategy yet, but it could. We don't know whether it will or not, but it's a company that has executed very, very well as well. RingCentral is going gangbusters, absolutely, and an excellent partner strategy. So that's one that you can look at. I've personally done very well with an investment in RingCentral. Workday is trying to do a PaaS strategy. So it's very early and immature at this point, but they're on my radar because I think if they successfully execute on a PaaS strategy, that would be an interesting company, and they have a good footprint to do that off. And then I'll give you some smaller players with revenues less than $1 billion. HubSpot is a very interesting developer ecosystem, very well executed company, very smart company. Alteryx is an excellent company. They have it was a very heavily bootstrapped company that later went public. Now it has been public, and excellent execution, doing really, really well. So you can look at that as well. DocuSign is a very good SaaS company that you could look at. Smartsheet, another good platform strategy. It's a collaboration, enterprise collaboration SaaS company. Anaplan is an interesting company in the planning area, SaaS area. Zendesk is doing very well in the cloud-based customer support area. And then you may want to look at the cybersecurity players like Palo Alto Networks, Qualys, Okta, which is an identity, and Proofpoint. So that's my list. There is a more comprehensive analysis of these companies on our blog under technology stocks. Look for cloud stocks, top 20 for 2020 for the more detailed analysis. But these are the companies that I've covered in that particular post. And with that, I'm going to answer the last question. How can I get feedback from you on my venture? Well, I'm very happy to give you feedback. 1 Million by 1 Million offers free and online mentoring roundtables for entrepreneurs looking to discuss positioning, financing, and all other aspects of building a startup venture. Up to 5 entrepreneurs who register to pitch will be able to present their businesses. They will get straightforward feedback, advice on next steps, and answers to questions from me directly, and possibly some of my guests who are CEOs and VCs. You need to register to attend or to listen, learn, and join in the conversations via live chat. These are held over WebEx. All those who register will receive the recording by email the next day. So go to the free public roundtable section of the blog and you'll find the schedule. You can sign up there. Those who register to pitch will receive instructions on the presentation format, what preparation is required, etc. We recommend that you go through our 1M by 1M self-assessment tool to help prepare to pitch. The tool is available from the website as well as a free questionnaire. Several entrepreneurs interested in pitching have first expanded their knowledge of the essential components of building a startup by joining our monthly 1M by 1M basic program and going through the 1M by 1M curriculum. If you're a first-time entrepreneur, you have a tremendous learning curve ahead of you. If you start doing the 1M by 1M curriculum through subscribing to 1M by 1M basic, and it's only $99 a month, it will help you answer the questions that you will face in the self-assessment. And if you do that and then come talk to me, it will be a more productive conversation. But regardless, I'm very happy to give you feedback on your venture at one of the upcoming free roundtables. Thank you very much. It was a pleasure spending some time with you today. I wish you a happy 2020 and a very productive 2020. I look forward to working with some of you on your ventures in the upcoming roundtables. And we'll be back here with another online rendezvous over LinkedIn Live, Facebook Live, as well as Twitter. See you then. Thank you for coming today. Bye.